Welcome to Mergers and Acquisitions. Today's topic is management buyouts. Now, in these transactions, the management of the company decides to purchase control of the company from the company's public shareholders. Now, what do managers and shareholders gain from agreeing to a management buyout? Well, obvious gains of going private are the savings from reduced regulatory and compliance costs, less stringent regulatory and disclosure requirements, the elimination of shareholder servicing costs. And those savings can be significant for smaller companies. If you've got a microcap company that's operating on fairly thin margins, the costs of being publicly held are non-trivial. For larger companies, though, there is usually another set of explanations. One example is the elimination of management shareholder agency costs. Where you have an MBO, the management group ends up owning a substantial part, if not all, of the equity of the company. And as a result, they have a much stronger incentive to pursue the best interests of the company as opposed to their individual self-interest. Their incentives to work harder and to make decisions that are in the long-term interest of the firm become much stronger. Finally, the substantial amount of debt that is usually incurred in a management buyout sops up free cash flow and thus eliminates another source of agency costs. Now, from the shareholders' side, the advantage of an MBO is that typically they will be paid a control premium for their shares. Thus, the shareholders will get a portion of the gains that the MBO will generate. The problem is that, in a sense, an MBO transaction is insider trading writ very large. What I mean by that is that managers will almost always have significant information advantages over the shareholders. And while it's, of course, true that the securities laws will require that managers share much of that information with the shareholders in connection with the transaction, it nevertheless remains the case that there will be persistent information asymmetries that favor management throughout the process. And basically, what happens in certain MBO transactions is that management has information that leads them to believe that the company is going to be worth significantly more in the future than the market now thinks it'll be worth. And thus, just as an insider trader trades on private information about future gains, management does likewise in this context. All of this suggests that management has a fairly significant conflict of interest in the MBO setting. Management, on the one hand, is an agent of the shareholders and has fiduciary duties to the shareholders. On the other hand, they're also acting as the buyer, and so they are both on the sell and buy side of the transaction. And so we are going to see courts policing management buyouts fairly closely, and we'll talk about judicial review in a few minutes. But first, let's talk about the structuring of an MBO. And the initial question that the managers have to ask is, how are we going to fund this transaction? Managers are rarely wealthy enough to buy the company using simply their own resources. And they're typically going to have to raise additional funds, usually in the form of debt financing. Now, there are a number of ways that this can be done. One would be simply a classic pure debt transaction in which management goes to an investment bank or a syndicate of investment banks and raises money, typically through the sale of bonds, which would typically be non-investment grade junk bonds because the company will end up assuming the debt. And as a result, its debt equity ratio will significantly shift towards debt. And that inevitably makes the company more risky. Another alternative that we don't see as much anymore is an ESOP driven transaction in which an employee stock ownership plan is used to acquire the shares, again, in a leveraged transaction. And finally, and perhaps most commonly these days, management can go in together with a private equity fund, such as KKR, uh, Blackstone, et cetera. And the private equity fund will contribute equity capital and also assist with borrowing. And after the transaction, the equity will be split between the private equity fund and the management. So let's talk about how a private equity driven management buyout would work. What is a private equity fund? Well, it's an investment company, and there will be a general partner. This will be the private fund manager. That general partner will then set up one or more limited partnerships that will raise money from institutional investors, pension funds, and so forth, and also very high net worth individuals. And then the limited partnership will be used as a vehicle for buying portfolio companies, for going out into the market and acquiring uh, companies. The, the limited partnership will then be used as a financing vehicle for acquiring various portfolio companies. Now, in a typical private equity transaction, the manager is not going to own these portfolio companies permanently. Instead, it's kind of like real estate flipping. They buy a company, they spruce it up, they clean up its organizational structure. Typically, they might shed certain divisions, certain assets that are less productive. And then eventually, the private equity fund will have an exit strategy. And we'll talk about the exit strategies at the end of today's talk. Now, in terms of conducting the management buyout, the private equity MBO is typically a leveraged buyout. What I mean by that is that neither management nor the private equity fund has sufficient resources to buy the company outright. And in fact, they don't want to do that. Instead, what they want to do is just as you might take out a mortgage to buy a house, they take out debt to buy a company. In fact, basically, a leveraged buyout is a lot like buying a house, except in a much larger sense and with many more zeros. The private equity fund and the management group will put up a certain amount of cash in the form of an equity investment. Then they will borrow money, typically, initially, at least some in the form of bank loans, but also then typically through the issuance of debt. And as I say, because the company ends up highly leveraged, that debt is usually non-investment grade junk debt. Once they have the financing in place, the actual legal structure of the transaction is very familiar. You can do it either as a merger, in which the private equity fund and the management group set up a corporation that is then merged with the target company. And in that transaction, the private equity fund and the management group end up owning all of the equity of the target company, and the former shareholders of the target company are bought out for cash. Now, alternatively, you can do it as a two-step transaction in which there's an initial tender offer by the private equity fund management group corporation for a majority of the shares of the target, followed by a freeze out merger. Now, what is the effect of the MBO? Well, as I said, it is to typically shift the debt equity ratio significantly towards debt. Uh, Once the company is taken private, once the company is owned by the private equity fund and management, and the existing shareholders have been bought out, the private equity fund and the management group will cause the target company to assume all of the money that they borrowed, to assume that debt. And so that the target company, rather than the managers and the private equity fund, are the ones that are actually liable on the debt. And this means that the target company's debt exposure is going to increase very significantly, whereas its equity cushion is going to shrink rather substantially. Now, as I said, the management buyout is inherently a conflict of interest transaction. And there will be, as we'll see in a minute, judicial review of that transaction that's much more exacting than would be the case with an arm's length merger. So, very often, part of the MBO process will be anticipating judicial review. Typically, the management group of the private equity fund would contact the target company's board of directors. And usually, the target company's independent directors would not be part of the buyout group. Actually, you don't want them to be part of the buyout group because that would give them the same conflict of interest that the management group has. But if the independent directors are not part of the buyout group, if they are not going to become shareholders in the post buyout company, then the independent directors don't have the conflict of interest that management has. And we can use a special committee of independent directors to negotiate on behalf of the target shareholders. And that's going to go a significant way towards cleansing the transaction. You often see a go shop period in which the committee of independent directors will have an opportunity to shop to see if they can find a deal that would be a better deal for the target company shareholders. And very often it'll be the case that there is potentially a better deal out there. After all, a management buyout transaction doesn't fundamentally change the business. It simply changes who owns the business. So it's not like a strategic acquisition where you're anticipating significant operating synergies as a result of the merger. And thus, it will be very often the case that in this sort of financial transaction, driven by financial buyers, that potentially you could find a strategic buyer that would be willing to pay more. And so the go shop process, if it's used, and it is increasingly used, but the go shop process is potentially a significant check on management's conflict of interest, at least in theory. In practice, perhaps not so much. Finally, you can use the MFW approach of having dual protections, having a special committee of independent directors approving the transaction, followed by approval of the transaction by a majority of the disinterested shareholders. And that's a potentially very effective cleansing approach in the management buyout setting. Now, as I said, go shops are often more effective in theory than in practice. The problem with a go shop in the management buyout setting is that in order to pay more, for the target company, the strategic buyer has to believe that they can do a better job of running the company than the incumbent managers. But the problem here is that persistent information asymmetry. The incumbent management group that's trying to buy the company inevitably knows a lot more about the company and thus is inevitably going to be better positioned to value the company and to project what the company is going to be worth in the future. Basically, again, it's like insider trading. And it may be the case that you, on the other side of the transaction, from the insider, are smarter than they are, and that it's smart for you to outbid them. But nevertheless, it's often going to be the case that bidders are going to look at this situation and say, maybe I'm smarter than those insiders, but they've got more information, and there's a real risk that I'm going to end up overpaying. In addition to that, the go shop process is often structured in ways that lead one as an potential outside bidder to conclude that the game is simply not worth the candle. For example, the go shop clause will often include a matching or a topping right, so that if the strategic buyer outbids the management group would have the right to either match or top that. And as we've discussed before, matching rights tend to create a disincentive for a competitive bidder. The competitive bidder invests a lot of time, effort, money in learning about the company and deciding to make a bid, deciding what price to bid, and then having expended that effort, finds that they don't get to acquire the company because the management comes back with a matching offer. And under a matching bid approach, the board is obliged to take the management group offer as long as it's of equal value. So the bottom line is that a market test through a go shop clause is often going to be used, but we often are going to be skeptical that a go shop is an adequate cleansing of management's conflict of interest. You still do one, but the board needs other confirmation that it's gotten the best possible deal here. So let's think about judicial review. And there are three modes of potential review for management buyout transactions. The first is, what are the liabilities of the board of directors that approves the acquisition? Whether the deal is done in a two-step transaction or a single step merger, you're going to have to get target board approval. And that means that the target board is vulnerable to being sued. The second potential source of liability, or the potential target of liability, would be the management group. They have an inherent conflict of interest. And this is very similar to the sort of related party transactions, what we called interested director transactions that we looked at in business associations, where you have directors or, and this is the important part, officers of the corporation entering into a contract with the company. The third source of judicial review would be an appraisal proceeding in which some of the target shareholders think the price is too low, and so they pursue appraisal. Well, let's first talk about the potential liability of the board of directors. We know that under the Revlon decision, there are certain situations in which the board of directors' responsibility shifts from being the defenders of the corporate bastion to being auctioneers charged with getting the best value for the shareholders. Post the QVC decision, The most important trigger for Revlon is a change of control. And a management buyout is definitely a change of control. You take a publicly traded company with no controlling shareholder typically, and the target shareholders are bought out, and control ends up in the hands of the private equity fund and a relatively small group of senior managers of the company. And so that's definitely a classic change of control. It's definitely going to be subject to Revlon. And so you are within the borders of Revlon land in this context. And the target board has the so called Revlon duties that we've talked about before. But as we've also discussed today, at least in terms of monetary liability, post closing liability, it will be possible to cleanse the Revlon liability, or at least the potential Revlon liability, by obtaining approval of the transaction by a majority of the fully informed, uncoerced, disinterested stockholders. Recall that in Corwin, the Delaware Supreme Court explained that Unical and Revlon were primarily designed for injunctive relief, where a bidder would seek to invalidate target board defensive actions so that the bidder's proposed acquisition could go forward. Unical and Revlon were not really designed to deal with the kind of situation we're talking about here. Here, typically, what would happen would be that there would be, post closing, a breach of fiduciary duty lawsuit brought against the target board directors, and they would seek monetary liability. Under Corwin, the Delaware Supreme Court explained that Unical and Revlon were simply not designed to deal with that situation. On the other hand, you're also dealing with the kind of conflict of interest that's much more pronounced than you have in arm's length mergers that would be subject to the Van Gorkum standard. So, what Corwin said is if you want to avoid Revlon type review of this transaction, what you do is you put it up to a vote of the disinterested shareholders. And if a majority of the disinterested shares are fully informed and uncoerced and voted in favor of the transaction, then the standard of review becomes the business judgment rule and not Revlon. What then about the potential liability of the management group? Well, this is, again, as I said, an interested director or related party transaction. And it's a classic example of the kind of contract that would be subject under Delaware law to Section 144, which deals with conflict of interest transactions involving the board or, and this is of course critical here, the officers of the company. And Section 144 provides for a mechanism for cleansing management's conflict of interest, just as Corwin provides a mechanism for cleansing the board's conflicts. And of course, there are two pertinent cleansing mechanisms under Section 144. One would be approval by the disinterested directors. And approval by the disinterested directors would shift the burden of proof from the management defenders to show fairness of the transaction, would shift the burden of proof to the plaintiff, the shareholders, and the plaintiffs would have to rebut the business judgment rule. Now, we just saw a second ago, though, that typically in these transactions, you're going to want to put it to a vote of the disinterested stockholders so that the target board can get the protections offered by Corwin. So you're normally going to submit this transaction to the second approach to cleansing it under Section 144, which would be approval by the fully informed disinterested shareholders. And just as that approval would invoke the business judgment rule under Corwin for the target board, that approval would invoke the business judgment rule under 144 for the management group. And hence, the Corwin approach of getting that disinterested shareholder vote has become a staple of the management buyout process because it's going to provide the cleansing for both the target board and the management group. Both of those cases, or if they're both brought, would be subject to business judgment review, with essentially the case being limited to issues of waste. You remember from business associations that waste requires a showing that no person of ordinary sound business judgment would say that you were getting a fair exchange for whatever it is that the transaction involves. So in other words, in this context, the question would be, is the price the management group is paying so low that no person of ordinary sound business judgment would say that the consideration that the target shareholders are getting for their shares is a fair exchange? The American Law Institute Principles of Corporate Governance is helpful here. It says that waste arises where no consideration is received in exchange and for which there is no rational business purpose, or the exchange, if there is consideration received, that consideration is so inadequate in value that, again, no person of ordinary sound business judgment would deem it worth what the corporation was giving up. So in this context, that would mean that the price the target shareholders are getting is so low that no one of ordinary sound business judgment would deem the shares to be worth what's being paid. And that's an extremely difficult standard to meet. Those of you that had me in business associations will recall one of my all-time favorite Delaware cases is Steiner versus Meyerson, because the court resorted to a cryptozoological analogy, saying that a successful waste claim can be analogized to the Loch Ness Monster, rare and probably non-existent. So no, once you have Corwin cleansing for the board, you have 144 cleansing for the management group. And by the way, you may say to yourself, why doesn't you do 144 for both the target board and the management group? The answer to that is that, remember, the target board is typically not part of the buyout group, right? As we said, we don't want the management board. As we said, we don't want the target board participating as part of the buyout group because that would subject them to the same sort of conflict of interest the management group has. And since the target directors are not part of the buyout group, they are not parties to the contract. They're not parties to the transaction. And so Section 144 simply doesn't apply to that. It only applies to those officers and directors who are actually parties to the transaction. In other words, it only applies to the buyout group. All right. Finally, there's appraisal, with all of the disadvantages that we know appraisal can involve. And the most important precedent in this context of late has been the management buyout of Dell Inc., the computer company. And in the Dell transaction, several large institutional investors perfected their appraisal rights. And as we talked about when we discussed appraisal, there's been a growing trend among the Delaware courts of deference to the deal price. Now, that's only when we're dealing with publicly traded companies, of course. But when you're dealing with a publicly traded company, as to which appraisal rights are available, and that would typically be the case in an MBO. Why? Well, remember that the out, if you will, the exception to appraisal rights that's available when the consideration is stock of the acquiring company doesn't apply where the consideration is cash. And these are cash transactions. And so, even though the target is a publicly traded company, because the consideration is cash, the market out in appraisal doesn't apply. And as a result, appraisal is at least potentially available in these cases. Dell argued we're a publicly traded company, and so the transaction price is the best available evidence of the fair value of our shares. And the court acknowledged that there have been a number of chancery court decisions that when you're dealing with publicly traded companies, the deal price is the most reliable indicator of the company's fair value, particularly when other evidence of fair value was weak or corroborated the deal price. But in Dell, the court declined to give dispositive weight to the deal price. The 5 cases that the court had referred to earlier were all arm's length transactions involving strategic buyers. Dell was a conflict of interest transaction involving a financial buyer. And so, in this context, you're not going to get the kind of deference that you would be anticipating in a non-MBO acquisition of a publicly traded company. So the Dell case isn't really a game changer for appraisal in general, but it is an emphasis that in these sort of conflict of interest transactions, that management is going to have to work harder to establish that the deal price is in fact the fair price. And the court, emphasized very much that the only active bidders in this situation were potential financial bidders. The pricing was based on a leveraged buyout pricing model. They were basically pricing the company at what they could afford to pay rather than what the company was actually worth. There was very limited pre-signing competition for the company. And yes, they had a go shop period, but the effectiveness of the go shop in this situation was particularly suspect because of the considerable size and complexity of Dell's business. All of the sort of usual problems with a go shop were present here, but the concern was that the complexity and size of Dell made those problems even worse. Finally, yes, there was a special committee, but the special committee really didn't do a very good job here. They simply assumed that there was going to be a management buyout, and everything they did was premised on getting the best LBO price as opposed to getting the best possible price overall. So the lesson for MBOs is that there is potentially going to be an appraisal claim. and that you're going to have to be able to document that what you paid was a fair price. But that's going to entail, your investment bankers doing discounted cash flow analysis and comparable transactions and comparable companies. And what you're really going to have the investment banker be very careful to do is particularly on like comparable transaction analysis to use non-MBO transactions involving strategic buyers, right? You're going to want to argue that essentially the price you're paying, if you're representing the management buyout group, that the price you're paying is what is in the range that a strategic buyer might have paid. Okay, so that's the MBO process. Now, as I said, from a private equity fund perspective, management buyouts are kind of like house flipping. And so the private equity fund is usually going to want to have an exit strategy. Exit would normally be 3, 4, 5 years out. And it can entail one of a number of types of transactions. Probably the best result for the private equity fund would be an IPO, to take the company private and then take it back public through an IPO. That's usually going to be the best available price, but again, it's subject to market conditions in your particular industry. Why, by the way, would the management group want to take the company private and then a few years later go back public? Well, a couple of comments there. First of all, the management group is typically comprised mainly of the C-suite, the chief executive officer, the chief financial officer, and so on. You're usually not talking about middle management. You're not talking about folks who are in the mid-career level. You're typically talking about the management group being comprised of folks who are at the end of their careers. And a 3, 4, 5 year exit basically means that they would get cashed out and enter into retirement with a very nice nest egg. In any event, as an alternative to the IPO transaction option, you could have a sale to a strategic buyer, a merger with a strategic buyer. Alternatively, one private equity fund could sell out its interest to another private equity fund. And this happens occasionally. Finally, you could do a recapitalization. And this would be typically done where the management group, for whatever reason, doesn't want to go back to being a publicly traded company, where the management group wants to keep the company being private. This would probably be most common in a family-run corporation where the family decides that they want to take the company private and be private permanently. And so what would happen would be that over time, the family management group would build up equity, but they would also build up relations with bankers so that at some point in the future, they would be able to do a pure debt deal and use the proceeds of a borrowing to buy out their private equity fund partner, and then keep the company private going forward. As I say, typically, if you're dealing with a non-family owned company, the management group is typically not going to want to stick around permanently. They will be thinking about their own exit strategy. So this is typically not something you would see outside the family context. All right. Thank you very much. And I will see you back in class.